Hey guys, this is another video about QQQ and how I'm managing my position. So just a few weeks ago, I had made a QQQ trade. It was a covered call position. And actually in the past 1 month, QQQ is up about 13.3%. So QQQ has just gone up a lot, and a lot of people are asking me how am I managing my covered call position. So that's what I want to talk about. And I also want to talk about, if you have a small portfolio, how would you trade QQQ, what expirations I'm looking at for triple Q. So yeah, let's go over this. First of all, I just want to cover some small account trading here before I go over my covered call position. I would specifically use credit spreads on triple Q right now. Credit spreads are, obviously a fantastic strategy for putting small amounts of money to work. And with a credit spread, you are collecting a defined premium, and you also have a defined set risk. So it's a fairly safe strategy, at least it's defined. What I mean by that is you're making $50, you're risking $450. That risk to reward may seem really off, but it's all about the chances of profit. It's all about the chances that you are going to be successful, right? So let's just go over an example. So 389 is the current price. If I look at year to date, we are sitting at an all-time high. So just being honest with you, things have been going really well, but at the same time, it's getting increasingly risky to hold technology companies. So it's always a double-edged sword. When things are going well, you feel good, but at the same time, there is a potential crash or potential correction right around the corner, or just a potential dip, right? You don't have to have a crash. Just, for example, the market could be sitting pretty high and then just have a bit of a correction before, going higher, just like we just saw this year from, mid-July to currently end of November, early December. So what I would do with triple Q is obviously I have a covered call. I'm using quite a bit of money. I'm using all of my capital essentially in my account. Let's go to sell put. Okay, so put credit spread is fantastic for riding the momentum higher. So let's say that QQQ rises, a put credit spread is going to benefit. And you can also do really short-term put credit spreads. So you can go like 1 day expiration and just pick a put credit spread that's like simply out of the money. So you would sell at 385, for example, then buy the 383. So as you can see here, that's a very small return. Now, what I would do instead right now, because the market is sitting pretty high, is I don't really like to bet against indices or index funds, right? So let's go to an expiration date, let's say November or December 1st. So I don't like to bet against the market just because the market does tend to rise. When I was working at a hedge fund, the lead quantitative analyst said that essentially he's almost always long stocks, since stocks are rising for all of history, and they have been for many, many decades, especially if you look on a longer term horizon. So stocks do have a tendency to rise, and therefore it is not so smart to do call credit spreads. But I'm going to show you a call credit spread because when the market is at a 52-week high, then yes, it can be smart to start to mix in call credit spreads because you want to be balanced, okay? So let me just go into 398 right now, 10 delta, so really, really low. So this is a very low delta, high chance of not happening, okay? And then you can just buy something like this, all right? So this is what I would do. I would play credit spreads right now. Not a bad return, actually. This is 5 days and almost 10%. So yeah, anyways, that's how I would play it. But now let's take a look at my position. So specifically, a lot of you guys have asked me, Henry, you opened up a triple Q position, it went up, and your covered call is losing money. Oh my gosh, it's losing money. Well, not even close. If you think I'm losing money, then basically you don't understand how a basic covered call even works. And this is the most basic strategy that you need to understand, okay? You just really, really need to understand triple Q and index funds, but you also need to understand how covered calls just simply work. I'm actually doing quite well. A lot of my positions right now are for a gain. Basically, actually, every single position I currently own does have a gain except for the covered call. So in some ways I am down, but honestly, that's not how it works. The way a covered call works is it's one position. Just TD Ameritrade has them separated, right? If I went to the total position, like my total exposure to triple Q, then my gain would be this 86,000 minus the 43,000. So it's literally about $42,200 in gains. So I have a $42,000 gain. Now, would I have been better off had I not done a covered call? The answer is yes. I would have actually been better off not doing the covered call. However, I didn't know that at the time. So whenever I opened up this position, right, it was several weeks ago, I didn't know that. So the fact of the matter is, at that point of time, I made the best decision possible, which was doing a covered call. Because when you're not doing covered calls, on average, you are leaving money on the table. That's because whenever you have a stock or an ETF where you have 100 shares, you're able to sell covered calls on your position and start generating income on that position. And that's why when folks have 76 shares or some random amounts of shares, right, I always tell them to round up the shares, buy more until you have 100 shares, and then start doing covered calls. The covered call strategy is proven, and it's been around for decades now. And the covered call strategy is essentially just a simple way to make income on assets. All right, so whenever I hold a stock, I'm always, really not certain of where it's going to go in the short term. Nobody really knows, not Warren Buffett, or really nobody can predict the market. So whenever you're holding a stock, say, really any stock, you don't know how high or how low it can go in the short term. So when you sell a covered call, you're doing a couple things. First of all, you're creating a margin of safety. So if the stock ends up going down, you have a cushion. Well, actually, let's just take my QQQ for example. So I sold a 375 call here, and when I ended up selling it, I sold it for, let's just say, about $10. The current price is 27, and it looks like I'm down about 61%. So let's just call it about $10 or so. In all reality, I think it was a bit higher than $10. It's probably around $13 or $14, but let's just say 10. So what that means is if QQQ were to go down, okay, whenever on my stock here, I would actually look like a genius, because when I sold it for $10, that's, $4,200. If this went down by 10 grand, at least I would be down 10 grand here, but this would be up, $4,200, right? So this is basically acting as a support system. So when the stock or ETF goes down, I am saving money. I'm not losing as much as the market is losing, okay? But when it goes up, yes, it is limiting my gain to a certain extent. So currently it's negative 43,000, but there's quite a couple of factors here. So for example, in March 15, as this option approaches expiration, it's also going to decay in value. Now, it's not going to decay like crazy, because if you do the math right now, it's 375, right? That's the strike price. And then the current price of buying this option back. So why don't I buy back? When can I make this decision? Well, right now 375 plus 27 is going to be $402.54. Okay, so 402.54, but currently QQQ is 389.51. So you can see there's a discrepancy here, and that's because this option has more value because of the time and the implied volatility. So the volatility in the future and the times the time is how much this is worth more than it is in the money. So I'm in the money by 389 minus 375 is about $14.51, right? This option is worth a lot more than that. Okay, so the difference there is what I'm going to make by waiting. And I do have a decision though. As I do approach March 15, I will look to roll this option up. But I typically don't roll so early, so it's only been a few weeks. So it's definitely too early to roll at this time, unless I really think that QQQ is going to rise a lot in the short term. Now, I also have some positions in QQQ that's also helping my position. So it's not just this covered call. I have also decided to sell some 350 puts. So right here, I'm up $5,200. So this is adding delta or adding exposure into QQQ. So not only do I have a covered call that's now in the money, yes, it's in the money, but now I'm also selling puts. So if it, jumps down, then that's gonna, get me more exposure. But if it doesn't jump down, well, it is what it is, okay? So I can't make any more money on the covered call per se, but at least this position where I sold puts is going to continue to make money. So I'm currently up 49%. It's going to make me another $5,000. And then I also have another QQQ position that's expiring basically December 29th, the last day of, I think this is the last trading day of this year, where I just sold this very recently. It was maybe a couple days ago. And it's a very early position for me, right? I sold 20 contracts. Quite a bit of money. I am using margin, guys. I love margin, and margin is something that I teach in my one-on-one program. Actually, I just launched a one-on-one where I am available through voice notes, text messages essentially, and that is the first link in the description. It's a new program. I think it's supposed to launch in January, but it is available now for 3 spots. So go ahead and click that first link in the description. It's going to look the same, but whenever you schedule an appointment and I speak to you, I'm going to be able to tell you about this one-on-one program with me personally. It's not expensive and it basically pays for itself in a couple weeks, so it's a no-brainer there, but spots are limited and I'm not going to work with just anyone because I don't need the money. I actually want to make an impact, so that's the most important thing and the reason why I'm doing this. Anyways, $375. I have more exposure into QQQ and so far I'm up $600. So again, I'm just long on QQQ. It's one of my favorite ETFs to have, and specifically I like it so much because it already holds the stocks that I really like. So rather than having to buy all the individual stocks, if I scroll up here, Apple is my number one position personally. So I've been invested in Apple for quite some time. I bought Apple at $176 and now it's around the high 180s, low 190s. So Apple has been my favorite position. I'm so happy that I ended up putting a majority of my money into it. And I'm also really bullish on the rest of the tech companies. Now, Microsoft, I'm a little bit shy on because Microsoft has run up quite a bit. I mean, if I look at the chart on Microsoft, it's really no joke. It's around a 52-week high. So if I go to year to date, it is sitting at a 52-week high, but so is QQQ. So that does make sense. Amazon, I really like. It is also at a 52-week high. So a lot of these stocks are now peaking and it's becoming a bit scarier, and I'm becoming more reserved on the market again. So I made quite a bit of money short term in the market, and now I do want to kind of protect myself in the next 2 to 3 weeks. And then obviously as the new year hits, the new year is a fantastic time to invest because there's something called the January effect where stocks rise quite a bit in January. It's a known fact. Meta is good. NVIDIA, I don't like. I have call credit spreads on NVIDIA, which is a bearish strategy. Yeah, on NVIDIA, I am a bit reserved. And then Google, I love Google. Google is great. Tesla's also good. Tesla's pretty volatile. So Tesla has some of the best options on the market, period. I mean, I gained a majority of my wealth actually in 2021 was from Tesla. So I did make a huge run up from 100K to 700K. A lot of that was Tesla options, but I didn't really miss. I didn't have too many mistakes on Tesla. I was really good with timing. I was really good with technical analysis. I caught Tesla at the right time. I did the right strategies. So as much as I want to be, humble and say, oh, okay, yeah, it was just like a good timing, it was also skill, right? So, there's a component of luck, there's a component of time, and there's a component of skill. When all those things align, you have to be in that position to make them align, you will make money. But the good news is, as time goes on, you keep putting yourself in a position to catch really good trends, then it's only a matter of time until you have some really big growth in your portfolio. So it is definitely lots of skill and knowledge there. So $235 right now on Tesla. It has gone up to almost $300. And then I saw some weakness here. I made some short-term money on Tesla. But right now, it is in an interesting position. I actually could see it being an iron condor. So let me show you what an iron condor could look like. Tesla's fairly range bound at the moment at $235 per share. I'm going to go to December 15, which is like 19 days away. You can easily play something like an iron condor. So I've looked at the technicals before I made this video just to save you the time. So I'm going to go to sell put 210 and I'm going to go to buy put at 205. That's a put credit spread. And now I'm going to go to sell, right? Because that's how you open up an iron condor. I don't see Tesla really going above 260 in the short term. So you can sell the 260 and then you can buy the 265. And essentially this right here is going to be an iron condor where you're making about a 33% return in just 19 days. So iron condor strategy is really strong on Tesla. And if you want to actually master iron condors, here's a video on the screen right now on how to actually open and close profitably iron condors.